Good Friday, everybody. I hope you're looking forward to the upcoming weekend. Sorry it's been a few weeks since I've posted a video. We're in the middle of extension tax season. Um, so I've been extremely busy getting tax returns out the door to make sure we meet the deadlines. Just happened to be between the corporate pass-through entity deadline and the individual deadline. Um, so this week I want to talk about some getting off something that really off the beaten path of taxes, and this is more of a recommendation on how to run your business. And this is really for single member LLC. So had somebody ask me the question, um, how much money do you recommend keeping in your business bank account? And I get this question quite a bit. I've never actually done a formal video on it, so I've decided to make a good topic. Now I do have to disclaim this. Um, I am not an attorney. I have never been to law school, and I am not providing legal advice. I am providing Jason's opinion on what appears to be best practices. My whole legal training was a single semester long business law class while I was going to the College of Business for my bachelor's in accounting and finance. So, by no means am I providing any legal advice. I put a disclaimer on every video I post. As always, you need to seek professional guidance if you actually have any questions. And if they are legal questions, make sure you're talking to an attorney with experience in business law. Okay, so what I'm talking about today is um, keeping how much money should you keep in your business bank account? Now, my personal take on this is really the only amount of money that you should keep in your business is the amount of money to cover your next month's of operating expenses. And I say that because and this doesn't apply to everybody. So this applies mainly to small business. Now, I need to define my definition of small business because the government's definition is making 27 million a year in revenue or less. So when I say small business, to me that's a big business. Um, I'm talking more like maybe making less than 1 million a year, maybe 5 million a year, depending on your industry. It's a little bit different for every industry. This could be making 50,000 a year in revenue. This could, 500,000, 100,000. But mainly, this is startups, maybe just past your first 5 years, whatever. You just a smaller, more kind of, I guess, what we would call a mom and pop shop in business school. Um, so typically, these types of entities are structured as single member LLCs. Maybe a married couple are both shareholders or members in the LLC. So it might be a partnership or a S corporation, but owned basically by two very closely related parties. This could be an entity that you're in partnership with close friends and family, stuff like that. So usually startups with one to maybe five owners. Um, and uh, And so I would say the what this all comes back to is the whole purpose of the LLC is to provide limited liability to the owner. So this is where things get fuzzy based on state law, your attorney, and guidance. Generally speaking, the whole purpose of the LLC is to protect your personal assets from negative consequences that happen to your business. So in business school, we use the term business risk. And that is just kind of a catch-all term that basically means anything negative that could possibly happen to your business. And there's no way of knowing whatever everything that could be. Typically, the biggest negative consequences would be a lawsuit. Now, uh, there could be other things like potentially bankruptcy court or an IRS audit that gets nasty or some other like there's a lot of things that could be negative consequences that fall into the term business risk. Um, but for the most part, what we're talking about is lawsuits. And depending on your industry, if you're like a fitness coach or a doctor or a nutritionist or providing some sort of legal counsel, like I'm a tax preparer, so I a CPA, so I give legal advice on tax law. Um, but basically, if you're required to have a business license through the state to perform any type of service, you're usually considered, that could be barbers, financial advisors, pesticide applicators or herbicides or fungicide applicators, all sorts of things. Anything that's like basically business license you have to have in order to make money doing it typically means you are classified by the state as a professional in your field and you are subject to potentially a malpractice lawsuit. Um, and so that could be, like maybe you give advice that gets somebody injured and they are now in the hospital and ultimately it's their insurance company suing you. That's the type of things I'm talking about. Now, the whole purpose of the LLC is to protect your personal assets. Again, that's where it gets kind of fuzzy because there's ways to pierce what we call the corporate veil. So that LLC is a corporate veil that is supposed to protect your personal assets. So, anything that you pull out of that LLC is then also protected by those personal assets or that as a personal asset. So, any cash that you have over or above and beyond what you need to cover operating expenses is at risk in the event of a negative consequence if it is inside your LLC. So, you pull it out through distributions to keep it safe. Now, granted, we don't know what the economy could hold. We don't know what's going to happen in the future. So you should always have a safe fund to protect your business in the event of something happen. Well, you don't have to keep that money inside your LLC. You pull that money out and you put it in a savings account or an investment account outside of your LLC under your personal name. This is why it has to be a small group of ownership, is because all the money in the entity is yours, so you can pull it out, put it into savings, and then in the event that you need to put money back into the company, it's just a cash contribution. So you have a cash distribution and a cash contribution. These are not taxable events. Basically, they increase or decrease your equity in the company. Absolutely no tax effect. So that's what I recommend is you keep just enough cash in your bank account to cover, excuse me, the next month's operating expenses. So then I have, well, what about like big businesses that have investment accounts and all this junk? Making capital gains, dividends, and interest. Isn't that good for the business to be doing? Uh, there's absolutely no tax benefit to having an investment account underneath your business's name. Now, if you are a traditional corporation, which most of my clients are not, there's actually negative consequences. So, a traditional corporation can't have long-term capital gains. So, why would you invest money under a traditional corporation? And then as a pass-through entity, as a LLC taxes a sole proprietorship, a S corporation, or a partnership. Uh, those dividends, interest, and capital gains all keep their nature and pass through to the owners the same way as if they had invested it all themselves. So there's absolutely no tax benefit to having investments through an LLC or through your business. and there could potentially, depending on your situation, be actually negative consequences. Um, and the other thing is when you distribute an asset out of a corporation, not a partnership, but a corporation, it's called a deemed sale. So you could actually end up having to, if you had stock or you had a land or a rental property or real estate of some kind inside a corporation, even an S corporation, if you distribute that out, you end up with a deemed sale. So lots of negative consequences, no additional benefit for taxes, so there's really no reason to keep investments inside your operating LLC. Not for tax purposes and potentially negative. Well, the reason why big companies do it is because of the ownership structures and also government regulations depending on the industry. So, if you have a Fortune 500 company with millions of shareholders, and dividends lower your equity in the company, that means you have to have approval from the owners to actually issue a dividend. So all dividends in large companies are voted on. And so then what you have is you have a company that has to keep at least enough cash inside the entity to cover its operating expenses, plus that savings account, in order to save itself should something happen, also has to be kept underneath the corporation, because it can't distribute out that money to millions of shareholders and then pull it back if it needs it. Uh, so then the next thing is if you're going to sit on cash, cash is just going to lose value over time. So you invest it. And that's why you have large corporations with large investment accounts, is because they're keeping their cash, making money, but they can't distribute it out to take it outside of the corporation, because then they would have to distribute it to all of the shareholders equally. And then the other thing is depending on the industry, like tech companies or insurance companies and some others, there's actually government regulations that say how much liquid cash they have to have, percentages wise, based on requirements on their balance sheet or whatever. So ultimately, you want to keep as little under that LLC as you can, because you want everything out so that it falls into the personal category to protect it in the event of something negative happening. So that's just kind of um, the things I don't know is what state you're in and exactly how that would play out. Typically, in like a malpractice lawsuit, they are personally suing you and also suing your business, because you're personally at fault. So that's one way they pierce the corporate veil. There's other ways to pierce the corporate veil, but ultimately, if it's inside the LLC, it could potentially be on the chopping block. And so, LLCs in different states also provide different protections. So again, this is a topic you should have with your attorney. But as just personal opinion, personal preference, if you're a single member LLC or a very smallly owned entity, you should not be keeping any investment accounts, any real estate, or any just cash savings inside your entity. Last thing I will say is a lot of people have read Profit First, and so we set up multiple bank accounts. You can have 20, 30, you can have as many bank accounts as you want. You just go open them and they'll open them all day for you. Now, these are savings accounts. So if you're following the profit first mentality, you have a savings account for your taxes, a savings account for operating expenses, you have a savings account for owner's pay and draw and all that stuff, right? Like that's the whole point of profit first, is you allocate out your cash into various designated accounts. Well, some of those accounts you do want to keep as business, and some of those accounts you want them to be personal. Even though the money's designated for something, doesn't mean it has to remain within your LLC. It can still come out. So if you're saving for taxes, well, pass-through entities don't pay taxes usually, especially at the federal level. The taxes pass through to you personally, and you pay at the personal level anyway. So if you're saving for taxes, keep that out personally and put that bank account under your personal name. If you're saving for owner's pay or the rainy day fund in the event of something bad happening, those accounts can be outside of the LLC. really only your operating account and maybe your payroll account should be in the LLC itself because that's covering ongoing monthly expenditures. Then if your accounts get low for whatever, then you transfer it from one of those personal accounts back into the business account as an owner contribution. So that's a way you can still follow profit first, but keeping cash outside of your LLC in the event that there is something negative. Okay, so that's all I have to say. Hopefully, this is beneficial for everybody. Have a wonderful weekend, and I'll see you next week.